In this video, I'm going to talk about two stocks that are huge red flags and that a lot of investors flock to and lose money with. And so you can avoid this process and know what to look for in the future when avoiding bad companies and not adding them to your portfolio. If you disagree with any of my selections, please leave a comment down below and we can discuss this. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. Also, I've changed the whole setup. I've moved a lot of furniture around. If you prefer this, please let me know. I'm still in the process. I'm going to move it about more, but by Saturday it should be finalised. So please let me know down below what you think of it. A very popular stock I've seen a lot of people buy lately, especially in like the Reddit UK investing forums where people share their portfolios, is Aston Martin. And they see this company, they think, wow, look how cheap, look how much value this share price has. It's like 95% off. I need to buy this right now. And it is a huge red flag, but maybe investors don't know what is wrong with it in the first place. Firstly, they aren't a dividend paying company, which isn't actually a problem, right? Because there are growth stocks. However, I would like to note this as they aren't a productive asset. And the way for you to get money is by others offering you a higher price than what you paid. Is definitely a very viable source of making money, but obviously you aren't getting paid dividends at the same time, and obviously companies can do this differently, and some don't need to pay dividends and some do. I just like to think that you aren't going to be earning any income with this share so long as you hold it, so you really need to look for the growth of it. And you may be thinking, well, they're trading at like 95% lower than last year. That's a great deal. Not exactly. As past performance goes, anyone who invested in Aston Martin or AML in the last year has lost a lot of their capital. It may be a low price now compared to what it was a year ago, but what's stopping it from dropping further or even going to zero? Looking at the price to earnings ratio, typically you want it to be a lower multiplier than the rest of the industry and the market. And yes, this is true, Aston Martin does have a lower multiplier, but it's negative. Negative is not what you want to see because this means the company is currently unprofitable, and therefore you aren't actually buying any earnings per share and in fact losing money. And this is a great red flag indicator because then you can instantly see, well, okay, something's up here, it's negative. This means they aren't earning money. I should really look at their balance sheet. And this is never good to see, and it's typically more of a high risk play because, I mean, sure, Tesla were unprofitable in recent years and look at their share price now. So you need to look at the trends of the history of the share price, the history of their revenue and earnings. Has it been downtrending for the last 5 years and now they've got horrible profit margins? I mean, look at Aston Martin. It did become profitable again in 2018, but since it has dropped considerably to now a point where it's at a negative 22.8% profit margin, which means they're losing 20% each year of their capital earnings, which is not good, and it's actually trending downwards further. For the future, it might not be a promising investment. And this is where the balance sheet comes in, and it's arguably one of the most favourable factors for AML, Aston Martin, and that's because they do have enough cash to keep the business alive, and this is called a cash runway. Basically, how much cash a business has that allows them to continue just surviving for the next period, a certain period of time, and then that's how long they've really got to be profitable or start making some serious changes. And at the moment, they've actually got 6 months of cash runway, which is good. It means the company will survive, and hopefully the pandemic will clear up more, and then they can reopen businesses and really change it up. In recent news, their actual CEO has been sacked. It does mean that they can survive the next 6 months with the cash that they have, and it's forecasted that they can survive another 5. However, you should consider, how have they raised that cash? If they're unprofitable, where has it been from? Well, this could be long-term cash holdings that they've had over a longer period of time, which might have been steadily decreasing. So this is where the balance sheet comes in. If you look at it over recent years, they might have had spare cash flow of like 200 million, for example, and now 2-3 years later, for instance, it's now only at 20 million. So you can see that they're depleting the cash reserve. And in recent years, if they've been raising cash, how have they been doing it? Well, it's very likely they've been diluting their share pool, which is never a good thing for investors. It's effectively the opposite of share buybacks. When a company buys more of their stocks, it decreases the current amount available to shareholders. And if there's less of something, there's a greater demand, and therefore it has more value. However, this means that because they've diluted their shares, all the shares as a whole become less valuable, and this is probably a significant contribution to why they've lost a high amount of percentage from their original share price. And if you look, they've diluted their shares by 566.7%, which is loads. I nearly swore then that was how much it is. And share dilution is not good for long-term investors, because if a company consistently increases the amount of available shares, you're effectively going to be losing capital growth. You might be okay if it's paying a dividend, but it's not something you want to see. But for Aston Martin's sake, they have to in order to survive. And personally, I would avoid this stock at all costs. You are very, very, very likely to lose money in investing in this stock. And then it might put off newer investors from investing because, oh look, I've just lost 80% of my capital. I really thought Rolls-Royce was going to go well. And then they're going to have such a negative bias towards the stock market and maybe not invest again. And then their retirement fund is going to be state pension. However, if you wanted to speculate or gamble, I could see some enjoyment you get for the price. Say, for instance, I just put £5 in equity onto Aston Martin. I might be rooting for them or supporting them in recent news and see how they perform over the next year. And it'd be like just cheering on a team in a football match. You look for this, you think, yes, come on, they're doing this, they're doing that, they're improving. It might be a nationalistic thing because Aston Martin is a British company. And there you might get more enjoyment just trying to see how the company performs. But I don't think you'll get much of a return on investment in terms of monetary value. And if you've enjoyed the video so far, please consider subscribing for monthly stock picks and weekly portfolio updates. Thank you. Next on the list is Centrica. And you may not have heard of them unless you're an experienced investor, and in fact you would have definitely experienced them at one point in your life. And Centrica has its subsidiary, which is companies they own, and that is British Gas, one of them. And if you live in Britain, it's very likely you know who British Gas are. They're an energy supplier that uses natural gas in order to supply many households with energy. And they've had extremely high yields in recent history, right? Like a 15% yield in June 2019. Like, if I buy that in 6.5 years, I'd have all my money returned to me. That's amazing, right? Not quite. You need to work out why the yield is increasing so rapidly. Sure, if you just look at the yield and see, oh, it's gone from 5% to 16% over the course of 5 years, that's incredible dividend growth. It may look like that, but in reality, it might be caused by a falling share price, as it's cheaper to buy that same amount of dividend yield. And this is in fact the case. Over the last 5 years, their share price has considerably dropped. And if you look at the dividend earning tab, you'll actually realise that since 2014, they've cut their dividend and then just continue to have it at the same level. They didn't grow it, yet the yield kept increasing. And then again, you can see that they've cut it and now eventually they've suspended it, which isn't good news because if you invested for dividend income, you really wouldn't have got much. Yes, before 2014, they were actually looking like a really good dividend growth company. And I don't think it's entirely their fault because at that point, I would have invested in them. But the government, I think, has changed their legislations and they've made it harder for energy providers to make a profit by limiting the price on energy. And since there's so much competition and little variety between them, it makes it difficult for them to get more of a profit margin. As well as the falling price for natural gas, it really makes it difficult for British Gas to do this. And if we look at their recent history in revenue, you'll see that they were making a profit and then they went slightly under, went back up, and then they've gone slightly under again. But their profit margin is only minus 2%, which isn't too bad. And this is certainly something in the future you could see improving if they restructure their business in a way that allows them to gain more profits. Well, in fact, they've also diluted their shares by that same amount. So in order to preserve capital and keep themselves afloat, they've diluted their shares to raise what they've lost. And if they continue to lose money, this could continue to happen. Therefore, the share price is consistently dropping over a period of time. And in fact, over the last 5 years, you would have seen a return of minus 82% with dividends reinvested. So you would have lost a significant amount of your capital. But I do believe this is in a much stronger position than AML. Firstly, this is pretty staple. People in England need energy for their households, whereas they don't need a nice new Aston Martin car sitting on their driveway. But I mean, we all know there are some households that have a nice car out front and then have nothing on the inside. And their balance sheet is in fact quite strong. Their short-term assets actually outweigh their long-term liabilities. They don't quite outweigh their short-term liabilities by 600 million, but it is quite close, and they do have that capital available. Their debt to equity ratio is quite high at 254%, but there is a chance in the future that they can reduce this, change their business model and make a profit. But I wanted to point out, if you take one thing from this video, it's this. Firstly, you don't want to blindly chase high dividend yield options, as it's very likely that they're losing share price. So what you're gaining in dividends, you're losing in share price, and overall you're going to lose more money. And secondly, when you think a stock is high value, you really need to consider why this is. You need to look at the recent history and the news about the company, their price to earnings ratio and their balance sheet and history, and see why these companies have performed so poorly in recent years. And if you're interested in UK dividend stocks for your watch list, then click the card at the top right of the video. Thank you all for watching. I'm Osborne Foreman. Have a good night.